Hi, this is Aldo Lagrutta, co-founder of the Technical Analysis Institute, and we're back with another exciting video for you on the ultimate way to use the stochastic indicator. So I hope you find real benefit from this video, and if you do, please consider subscribing and click the like button below. Thank you. Enjoy.
Although divergences by themselves are not truly reliable trade signals, they'll play a very important role in your analysis and decisions. In this lesson, we'll see a second way that the same oscillator can give us trading signals. Remember how I told you that an oscillator would tell us exactly when the markets are overbought or oversold? Let's see that in more detail. When the stochastic goes above the 80 area, it indicates that the market is overbought. When it comes below the 20 area, it indicates that it is in the oversold zone. The problem is that being overbought or oversold doesn't necessarily indicate that now prices are going to move in the opposite direction. In other words, stochastic is not a timing indicator. And sometimes, when there is a sustained move in a specific direction, stochastic may remain in the overbought or oversold areas for extended periods. For instance, in this chart, you can see two blue rectangles showing overbought. The first one started on the 7th of April and remained overbought until the 12th of April. The second one started on the 22nd of April and stayed overbought until the 28th of April. In the meantime, prices continued moving higher during both periods. And this can happen for weeks and sometimes even months. So that is not very helpful, is it? Please notice that both of these examples actually show divergences, and eventually prices did come down. But they also show that we cannot just sell a financial instrument because an oscillator shows that it is overbought. The question is there any other way to use stochastic effectively besides identifying divergences? The answer is yes. There are three other significant ways we can use stochastic. The first one is by waiting for both lines of the stochastic, percentage %K and percentage %D, to come out of the overbought or oversold areas. In other words, if we want to sell, we wait until both lines are in the overbought area and then start to fall down, penetrating the 80 reference line from above. If we're looking to buy, then we apply the opposite technique. We wait until both lines are in the oversold area and then start to climb up above the 20 reference line. The second way to use stochastic is very useful. You simply wait until the two lines, percentage %K in blue and percentage %D in red, cross. And that gives you a buy or sell signal. However, you still have to wait until both lines have penetrated the overbought or oversold areas if the crossing occurs within those areas. Once they are both in the oversold area and they cross up, you have a buy signal. Once that both lines have gone into the overbought area and they cross down, you have your selling signals. This method will work well, but statistically, it will give you a lot of false signals. And that is a very important reason why we need to combine stochastic with a clear understanding of what is going on in the market and other trading tools that we will explore in future lessons. And finally, the last and most reliable method is by taking the two signals described above, but only in the direction of the trend. You can see on this chart of the USD CAD, I marked two buy signals with percentage %K crossing percentage %D from below in the direction of the uptrend. And you can also see how both signals worked beautifully. Here's another example for you. This is a weekly chart of the mini S&P 500. You can see it is obviously in an uptrend. So the only valid signals of the stochastic would be buy signals. That is, when percentage %K, the blue line, crosses percentage %D from below. It's worth noticing that it matters not if the market is overbought or oversold. All the buy signals work perfectly well while the market is in an uptrend. So the crossing of the lines may occur in the middle or even within an overbought area. And this is indeed the way that stochastic works with high accuracy. In order to learn how to recognize the trend, however, you will need to learn more tools in the next few lessons. Now, your homework. First, identify all overbought and oversold areas in your charts. Mark the different buying and selling opportunities given to you by the crossing of the two stochastic lines. Then mark the different buy and sell signals given to you when the two lines come out of the overbought or oversold areas. And finally, take trades based on the different signals of the stochastic, including those from divergence, but always in simulation.